Investing in the stock market can seem pretty scary if you've never done it before. I've noticed this fear in my friends and family when I've tried to help them start investing, and I felt the same way when I was first getting into it. But one cool thing about investing in dividend stocks is that many of the companies that pay dividends are well-known household names. These are businesses whose products you probably use regularly, which can make investing feel less intimidating, and I think can even make it exciting. In this video, we're going to be taking a look at 20 of these companies. I guarantee you'll have heard of most of them, and they're all great ones to consider if you're just getting started with investing and are looking for some dividend-paying stocks to add to your portfolio. Now, like I mentioned, many of the great dividend-paying companies out there are well-known household names, and that's the first place we're going to start. I'm sure you're familiar with things like Crest toothpaste, Tide laundry detergent, Clorox bleach, and Band-Aids. You probably have all of these things somewhere throughout your house. Well, those are all made by these three dividend-paying companies here. We have Procter & Gamble, they're the first one, ticker symbol PG. We have Clorox, CLX. And last but not least, we have Kenvue, which is a company that you may not have heard of before. This company recently spun off from Johnson & Johnson in the healthcare sector, and their portfolio consists of products like Tylenol, Band-Aid, Neutrogena, and Listerine. Now, comparing the dividend stats real quick among these three, there's a couple things to note here. Number one, Clorox has the highest yield out of the bunch, coming in at 3.4%, but Procter & Gamble there has the highest dividend growth rate, or the dividend growth CAGR. That number there tells you the average amount that the company has raised the dividend by every single year on average over the last 5 years. So for Procter & Gamble, that number is 5.6%, and then Kenvue actually doesn't have a dividend growth CAGR, and that's because, like I said, they just recently spun off from Johnson & Johnson in the last year, so they haven't had the opportunity to establish a real dividend growth history yet. Now, out of the bunch here, if I just had to pick one of these to invest in, I would go with Procter & Gamble, and in fact, I actually do have this one in my portfolio. It's one of my largest positions. I just think Procter & Gamble has the most diverse and essential lineup of products. They make things that people need to buy no matter what, like toothpaste, laundry detergent, deodorant, diapers, paper towels, toilet paper, and so much more, and all of their brands really are the cream of the crop. Overall, in my opinion, it doesn't get any more dependable than a company like Procter & Gamble, and that's why I think it's such a great investment for brand new investors, or really any investor. Now, as far as Procter & Gamble's dividend stats go, we've already seen their yield, which is sitting at 2.5%, and we've already seen their 5-year dividend growth CAGR coming in at 5.6%, but one of the coolest things about this company is they have been making dividend increases for the last 67 straight years, which makes Procter & Gamble a dividend king. Now, a dividend king is a company that's been able to consistently increase their dividend every single year for at least 50 consecutive years, which is no small feat. And Procter & Gamble's been able to do that and then some, and that's not the only dividend king we'll see today. There's actually quite a few on our list here. In fact, if we jump over to the food and beverage category, 2 out of these 3 companies are also dividend kings. Right there at the top, we have Coca-Cola, ticker symbol KO, we have Pepsi, PEP, and last but not least, we have the Hershey Company, HSY. Both Coca-Cola and Pepsi are dividend kings, but the Hershey Company's dividend stats are really not too shabby either. Out of the bunch, as we can see, they have the highest dividend growth rate there, over double digits at 10.1%. Now, in my opinion, I really don't think you could go wrong with any of these companies. I actually have a few shares of Coca-Cola in my portfolio, but out of the bunch, I've got to say, guys, I think Pepsi probably is the top contender. Similar to Procter & Gamble, Pepsi has the widest product mix that stretches far beyond just their namesake soda. They also own a ton of other beverages like Mountain Dew and Gatorade, and a lot of people don't know this, but they also own all of Frito-Lay. So they own Lay's, Doritos, Cheetos, Fritos, Tostitos, Funyuns, Miss Vicky's, and all of these other brands here. So they are very well diversified. And looking at the dividend stats overall, I think these are very well-rounded stats. The yield is coming in just over 3%, which is pretty nice. The 5-year growth rate's pretty respectable as well at 6.6%. That's a pretty moderate rate of growth. And like I said a few moments ago, Pepsi is a dividend king with 51 straight years of dividend growth, which is very impressive. Anyway, moving on. So far, guys, we've pretty much only been talking about different consumer-facing products, and this next category of companies are places that you would go to buy these consumer products. We're talking about grocery stores, and on our list, we've got 4 great ones that you're definitely familiar with. You probably shop at one of these 4. I mean, we've got Costco there at the top, we have Kroger, ticker symbol KR, we have Target, and we have Walmart, and that's where I do all of my grocery shopping. We actually have a really nice Walmart like right around the corner from me, so it's very convenient. And real quick, comparing the dividend stats between these 4 companies, we can see that 3 out of the 4 are dividend growth behemoths. Costco, Kroger, and Target all have double-digit dividend growth rates, which is very nice. We love to see that. And admittedly, out of the bunch, Walmart's dividend stats are really not that great. They only have a 1.4% yield and a dividend growth rate that pales in comparison to those other 3. It's not even close. But having said that, I still don't think you could go wrong owning any of these companies. I think they're all great ones, but Costco, if I had to pick just one, would be my top pick. Costco's membership revenue is a huge competitive advantage that they have and has helped generate really solid and consistent growth in the company's financials over the years, and that's likely to continue as time goes on. But the one downside to Costco, I will say, is the starting dividend yield. Out of the 4 companies we looked at, Costco does have the lowest yield at 0.6%, but the 5-year dividend growth rate, in my opinion, more than makes up for that, 12.4%, and they've been growing this dividend for nearly 20 years, so it's really consistent in the growth department as well. But anyway, these next 2 companies that we're looking at are ones that I know you're definitely familiar with. We're looking at 2 of the world's most popular restaurants, McDonald's and Starbucks, and the dividend stats between these 2 are actually pretty similar. The starting yields are pretty identical, 2.3% and 2.4% respectively, and the dividend growth CAGRs are pretty close. I mean, there's a couple percentage point spread between the 2, but still for McDonald's, an 8.3% dividend growth rate is not bad. And you know I love Starbucks there with a 10.4% dividend growth CAGR. Now really, you can't go wrong with McDonald's and you can't go wrong with Starbucks, but out of the 2, Starbucks is the one I personally own, and this is another one of the largest positions in my portfolio. As a frequent Starbucks customer myself, I just know how religious people are about their Starbucks. It's a part of many people's daily routine, and I know it's $5 coffee and a lot of you guys can't justify spending that, but for many people, the daily ritual at Starbucks is like a key element for survival. Anyway, moving on, these next 2 companies are pretty much the only key players in the home improvement space, and you've definitely heard of them. We've got Home Depot and Lowe's. As you can see, the dividend stats between these 2 are relatively similar. Both have pretty moderate dividend yields, both have really high dividend growth rates, but the key difference between these 2 in the dividend department is their dividend growth histories. Looking at Home Depot, they've been paying their dividend for the last 32 straight years without interruption, which is pretty dang impressive, and out of those 32 years, they've been increasing the dividend for the last 14 of them. And looking at Lowe's, this situation looks a bit better. They've been both paying and growing their dividend for the last 6 straight decades, so the dividend growth history here is obviously considerably longer. And out of the 2, Lowe's is the one that I choose to have in my portfolio. I really love this company. Once again, it is one of my larger positions. Now next up, we're going to jump over to the technology sector and take a look at 2 of the world's largest companies. These are Apple and Microsoft, and believe it or not, they both do pay a dividend, albeit a pretty small one. I mean, as you can see, they both have yields below 1%. And because of that, many investors don't consider these to be dividend stocks. In fact, it might even be blasphemous to refer to them as dividend stocks, which who cares? They're dividend paying companies, so it's whatever. Now, I personally only have Apple in my portfolio, but Microsoft is a fantastic company to own as well, and I think they both have their own unique strengths and competitive advantages. Apple's strengths come from its brand, ecosystem, and customer loyalty. I mean, once you're in with Apple, you're in there pretty good. Now, Microsoft, on the other hand, has a wide moat due to its dominant position in enterprise software, especially with products like Windows and Office, and Microsoft has also diversified into cloud services, gaming, and LinkedIn, providing them with a more varied revenue stream. All in all, once again, you can't go wrong owning either of these companies. You can't go wrong owning both of these companies. I know many investors who choose to have both Apple and Microsoft in their portfolio because they're both great ones to own. Not unlike these next 3 we're talking about in the payment technology industry. We've got Visa, MasterCard, and American Express. And looking at the dividend stats between all of these 3, there's a lot of similarities, definitely more similar than different, right? I mean, for all 3, we have low starting yields and we have really nice double-digit dividend growth CAGRs, with MasterCard coming in at the highest at 17%, but Visa's is not too far behind that either, with a dividend growth CAGR of 16.3%. Very impressive. I actually just added Visa to my portfolio a couple of weeks ago, and in this next video right over here, I'm telling you all about that and why I think this is one of the most perfect companies I've ever come across. I absolutely love Visa, and I think it's a great investment for any investor. So click right over here to find out why, and I'll see you in the next one.